Yeah, again, this is a long-term stance for us. We've been fairly negative on China and the impact that was going to have on Australia for the past 4 or 5 years now, and we had 3 prongs to that strategy. Number 1 was try and avoid the resources space as much as possible. Number 2 was get foreign currency exposure even into our Australian portfolio. So we've owned things like RNY Property Trust and lots of other US dollar exposed assets in the portfolio. That has served us very well, both of those 2 prongs. The third prong was be very wary about the flow-on impacts to the wider Australian economy. What's going to happen to unemployment? What's it mean for house prices? What's it mean for consumer spending in Australia? And we've been very cautious around exposure to those places in the Australian portfolio. Now, we've seen the first 2 really unfold. The third, I think, is not priced in at all into Australian equity prices. You look at things like the banks, which are, I would say, quite exposed to all of those areas, and you've got share prices hitting record highs. So we've been hanging on for a long time. We've been waiting for this China slowdown to hit. We're really starting to see it now, and for us, we're scurrying around making sure that every time we sell something, we don't put that money back into something that is exposed to that Australian consumer. And it's not, we're not going all to cash. I don't think the world is going to collapse for the Australian economy. I just think it's a time to be really wary. I think it's time to try and build a portfolio that is robust against those risks, and that's what we're trying to do at the moment.